Hello and welcome to this seminar on reforms to IR35. My name is Ros Martin. The off-payroll or IR35 rules were introduced in 2000. The intention of these provisions were to attack individuals who were effectively employees but were providing their services through an intermediary, such as a personal service company. The legislation meant that they could not avoid the income tax and national insurance contributions which would have arisen if they had been employees simply by utilising such an intermediary. The legislation only applied in situations where the individual would have been an employee in the absence of that intermediary, and the legislation failed mainly because individuals simply changed their contracts, so they could argue they did not fall within the rules. HMRC also failed to adequately police the system. They vastly underestimated the number of personal service companies that would continue to be used. And they were also hampered by the fact that it was not always easy to spot a company which might be caught. So for whatever reason, the use of personal service companies exploded and HMRC did not get very much extra tax. The basic premise which underpinned IR35 in 2000 was that it was up to the intermediary, the personal service company, to decide if IR35 applied, and if it did, they calculated tax and national insurance contributions that were due on something called a deemed employment income payment. Changes to the IR35 regime were first made in 2017 and only applied where the end client was a public sector organisation. The fundamental change which took place at that time was that the responsibility for determining whether IR35 applied moved to the client. If the client assessed that they were caught, they had to deduct payroll taxes from any payments being made to the personal service company. Statistics released at the end of 2019 suggested that around 60,000 individuals had been recategorised under these changes, with around £400 million worth of extra tax and national insurance contributions being collected in the first year of its operation. It is certainly true to say that there were widespread changes in the way in which workers were engaged by public sector organisations as a result of these changes. With the success of the changes to the public sector rules, there was a degree of inevitability about the fact that HMRC would consider extending these to the private sector. HMRC estimate that non-compliance in this sector will reach £1.3 billion by 2023-24 in the absence of any changes, and therefore it was announced that they would extend the changes to the private sector with effect from the 6th of April 2020. There are a few amendments being planned to the legislation, and these will also apply to the public sector, with one exception which we will discuss below. So the general provision is that private sector end clients will be dealing with the same provisions as apply to the public sector. However, there is one significant exception, and this exception does not apply to public sector businesses. In the private sector, where the end client is a small business, they will not have to engage with the changes. If you are working via an intermediary for a small business client, then it will remain the responsibility of the personal service company to decide whether IR35 applies. When we are looking at corporate entities, the definition used is that at section 382 of the 2006 Companies Act. So you will be a small business if you satisfy two or more of the three criteria, being annual turnover not more than 10.2 million, balance sheet total not more than 5.1 million, number of employees not more than 50. There are specific provisions within the legislation about how you apply those limits where the company is a joint venture company or a subsidiary, which basically means that the other involved parties have to be taken into account when working out whether something is a small business. It should also be noted that these rules apply to LLPs, unregistered companies and overseas companies as well. For non-corporate entities, only the turnover is considered, so for a non-corporate, you'll be caught by these new changes if your turnover is more than 10.2 million. There is also an anti-avoidance provision for all businesses which takes account of the turnover of connected persons in determining whether a business is small, with the normal definition of connected persons applying. There are also obviously transitional provisions for those businesses which move from being small to medium or the other way. In terms of the commencement of these rules, for companies and LLPs, we would be testing those relevant limits for the accounting period ending before the 6th of April 2020. For individuals and partnerships, that would be the basis period figures forming the taxable profits for the 2019-20 tax year. Going forward, for companies, a company will need to meet the conditions for 2 consecutive years, and then the new rules would be applied from the start of the tax year following the end of the second financial year when the conditions are met. For unincorporated businesses, the rules must be applied from the start of the tax year following the end of the first calendar year when the conditions are met. There are certain information requirements and additional provisions introduced as part of these changes. The first one relates to supply of information down the supply chain. This will be relevant where there is more than one intermediary, but also where you have somebody providing their services directly through a personal service company. Clients must provide a status determination statement called an SDS. This must be given to the worker and any other person in the supply chain, such as an agency. End clients must make sure that they have processes in place to make sure that they can make the SDS and pass it on to all the relevant parties. If no SDS is produced, the end client will take on all the responsibilities to operate pay-as-you-earn and national insurance contributions, assuming that actually the person is caught by IR35. There is an updated employment status checker called CEST, which was released in November 2019 to help businesses make those status determinations. And the CEST is subject of a separate training module released this month. One of the major criticisms of the public sector rules introduced in 2017 has been that there is no right of appeal against a status determination if the worker did not agree with the outcome. The draft changes to the IR35 legislation to take effect from April include a right of appeal, but importantly this is not to HMRC. Effectively, end clients engaging persons via intermediaries must have a process whereby the worker can challenge the SDS. The engager must respond within 45 days stating the reasons why or why not they have come to the conclusion that they have, and indicating if they have changed their views on further reflection. At this point in time, it is very unclear how this will operate. HMRC have stated they will not get involved in any disputes, but they are planning to publish further guidance on how disputes should be resolved. There will be 2 types of non-compliance associated with the new IR35 rules. The first one will be in relation to information. The second will be in relation to the payment of taxes. If a status determination is not correctly communicated down the supply chain, the draft legislation allows the income tax and national insurance liabilities to be transferred from one party to another. So even though, say, if you have a worker, a personal service company, an agency and an end client, even though the normal principle would be that the end client makes the determination, but it will be up to the agency to deduct tax from any payments made, if the end client did not provide a determination, then the responsibility for any unpaid tax would then fall back on the client rather than the agency. If once determinations have been made, there is a failure to make the tax payments, the liability will initially rest with the party that has failed to fulfil that obligation. However, the legislation also allows for that liability to move down the supply chain, or indeed back up the supply chain to the end client. So ultimately, if HMRC cannot collect the tax from other parties, they will seek the payment from the client. The end client will always be liable for any additional tax where an incorrect status determination is made. So if they decide that IR35 does not apply, but HMRC's view that it is, then it will always be the end client who is liable for that. Okay, let's just have a look at one or two final points. Where the person who should be paying the tax over to HMRC is based offshore, any responsibilities that they would have to deduct tax move up the supply chain to the next UK-based entity. And as discussed in relation to the previous slide, this would ultimately mean that the end client could become responsible if they are utilising offshore agencies or other intermediaries in order to engage UK employees. IR35 can only apply if the employee who is actually doing the work, or the deemed employee who is doing the work, is UK resident. Under the original IR35 provisions, a deduction was made from earnings in the personal service company at 5%, and also there was a deduction available for other costs incurred by the personal service company. As with the public sector rules that apply, there are no deductions in determining the amount of tax due in relation to engagements which are caught by these provisions. I've alluded to this point already, but the payment of tax and national insurance contributions does follow the same model as applied for the public sector, which basically means that tax and national insurance contributions are deducted by whichever organisation is actually paying the personal service company, unless one of the provisions that we've already discussed comes into play and the liability moves back up the supply chain. Any employer's national insurance contributions paid under these provisions are not relevant liabilities for the purposes of the employment allowance, so you cannot claim the employment allowance against secondary Class 1 liabilities arising under IR35. Where there are agencies or umbrella companies involved, then it is likely that they will have an obligation to operate tax and national insurance contributions under other provisions, and therefore it is unlikely that IR35 will continue to apply. And then finally, where the conditions for IR35 apply, they take precedence over the managed service company provisions and also over the rules relating to the construction industry. Thank you for your time listening to the seminar. I hope you have found it useful, and goodbye.